It is Tuesday in New York, and Bank of America has just detonated a financial shockwave that is racing through Wall Street faster than most traders can process. A warning has surfaced that silver is mathematically positioned for a historic repricing, not because of hype or speculation, but because the gold-to-silver ratio is approaching a structural breaking point. As screens across Manhattan glow with silver holding steady near $78, the implications of this message are only beginning to sink in. The date is Tuesday, January 6th, 2026, and the financial atmosphere feels unusually dense, the kind of tension that often arrives before a major shift in asset valuations. Morning light reflects off the glass towers of lower Manhattan as institutional desks settle in, watching silver fluctuate quietly between $78 and $79 per ounce. Retail investors focus on minor intraday movements, debating whether a $2 move signals risk or opportunity. Meanwhile, a report released only hours earlier is already circulating through Wall Street's fiber optic arteries, changing the conversation entirely. Bank of America has published a document now known internally as the Price Fracture Report, and it carries implications far beyond conventional analyst commentary. Authored under the guidance of Michael Whitmer, the bank's head of metals research, the report abandons conservative forecasting and instead lays out a framework built on historical mechanics and market physics. Whitmer argues that silver is not entering a speculative phase, but a structural revaluation driven by mathematics rather than sentiment. According to the report, silver is positioned for a rapid escalation that could drive prices toward $135 and potentially as high as $339 per ounce. These targets are not anchored to new mining discoveries or short-term geopolitical disruptions. Instead, they are derived from a deep examination of the gold-to-silver ratio, one of the oldest valuation tools in financial history. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold, and it has served as a reliable compass through centuries of monetary cycles. As trading unfolds on this January morning, the ratio sits near 59 to 1. Bank of America identifies this level as dangerously stretched relative to historical norms. Whitmer highlights that during the last major silver surge in 2011, the ratio compressed sharply to 32 to 1. If the market were to repeat that same mechanical adjustment today, while gold remains at current levels, silver would instantly reprice to approximately $135 per ounce. The report does not stop there. It extends further back into history, revisiting the inflationary crisis of 1980. During that period of extreme monetary stress and currency debasement, the gold-to-silver ratio collapsed to 14 to 1. Bank of America's analysis shows that if such a compression were to occur again within the financial conditions of 2026, silver would reach $339 per ounce. This projection is framed not as fantasy, but as a statistical reversion that has occurred multiple times across the past century. At a current price of $78.84, Bank of America does not see silver as expensive. Instead, it is described as sitting at the midpoint of a much larger move that is only beginning to accelerate. Investors watching charts nervously are being told that fear of a collapse is misplaced. Historical bull markets show that silver consistently outperforms gold in the later stages of monetary cycles, driven by ratio reversion that forces capital to correct imbalances. When the ratio rests near 59 to 1, it signals that silver's industrial and monetary roles remain undervalued relative to gold. History demonstrates that once this disconnect resolves, the correction is violent and rapid, often unfolding in months rather than years. Bank of America frames the $78 level not as resistance, but as a temporary pause before the ratio resumes its descent. A move to $135 requires only a standard market adjustment similar to 2011. A move toward $339 represents a full return to the monetary dynamics of 1980, when silver functioned as a primary store of value alongside gold. This creates an asymmetry where downside risk is limited, while upside potential expands dramatically beyond current prices. As trading algorithms ingest this data throughout the morning session, what distinguishes this moment is the source. This is not coming from an obscure newsletter, but from one of the largest financial institutions in the world. Whitmer is effectively telling Bank of America's clients that focusing on silver as nominal price is the wrong approach. The critical variable is the relationship between gold and silver, which is now stretched to a point of instability. By mid-morning on Wall Street, the implications of a ratio moving from 59 to 1 toward 14 to 1 begin to crystallize. Such a shift would represent one of the largest transfers of wealth from fiat currency holders to tangible asset owners in modern history. And what felt expensive days earlier now appears profoundly mispriced. The Price Fracture Report draws a clear boundary around asset valuation in 2026. This Tuesday morning narrative is no longer about daily price swings. It is about a mathematical framework that reframes silver as a strategic monetary asset undergoing structural repricing. The era of viewing $78 silver as a ceiling is quietly ending, replaced by a model that views it as a foundation for what comes next. The story unfolding on this Tuesday morning in January 2026 does not stop with ratios and price targets. Bank of America Anticipated report expands into a far larger issue that sits beneath the surface of global markets, one that reveals a dangerous imbalance in how capital is positioned across asset classes. At the center of this imbalance is a massive liquidity gap that suggests the professional investment world is critically underexposed to precious metals at precisely the wrong moment. According to the data outlined in the price fracture report, gold and silver together represent roughly 4% of the total measurable global financial market. This includes equities, bonds, derivatives, and real assets. Yet despite this share, the actual allocation by high net worth investors, pension funds, endowments, and family offices tells a radically different story. Bank of America's analysis shows that these entities currently hold only about 0.5% of their total assets in gold and silver combined. This 0.5% allocation is the statistical anomaly that underpins the bank's most aggressive conclusions. It signals not enthusiasm, but neglect. Michael Whitmer and his team argue that such an extreme underweighting is unsustainable in the economic climate of 2026, where inflation risk, currency debasement, and sovereign debt concerns dominate long-term portfolio strategy discussions. The report frames this imbalance as compressed energy waiting to be released. Bank of America ran extensive portfolio optimization models calibrated specifically for current economic conditions. These models incorporated inflation persistence, monetary expansion, fiscal deficits, and declining confidence in traditional fixed income instruments. The result was a recommended allocation of 20 to 30% in gold and silver for a portfolio designed to remain resilient through ongoing currency erosion. This recommendation represents a dramatic departure from the traditional 60-40 stock and bond framework that dominated previous decades. The gap between 0.5% and even the lower bound of a 20% allocation represents trillions of dollars in potential capital movement. This is the wall of money referenced throughout the report. Unlike equity markets with deep liquidity and constant issuance, the precious metals market is physically constrained. The available above-ground investment-grade silver supply is small relative to the scale of global capital-seeking protection. Bank of America emphasizes that even a minor shift by institutional players would have outsized consequences. If allocations moved from 0.5% to just 1%, demand for physical bullion would effectively double overnight. For institutions managing billions of dollars, a 1% reallocation requires the acquisition of millions of ounces of silver. The report stresses that the silver market is simply not built to absorb flows of that magnitude without violent price adjustments. Unlike bonds or equities, silver trades in a market that is thin, fragmented, and illiquid at scale. Large purchase orders cannot be quietly absorbed. They move the market immediately. This structural illiquidity is identified as a primary driver behind Bank of America's expectation for triple-digit silver prices and the parallel projection of gold approaching $5,000 per ounce. The report makes it clear that institutional investors are behind the curve. Whitmer is effectively signaling that professional money managers must aggressively increase exposure before the market reprices beyond reach. The recommended 20 to 30% allocation is not framed as aggressive speculation, but as a defensive necessity in a world where fiat credibility continues to erode. This reallocation thesis challenges deeply embedded portfolio assumptions. For decades, diversification meant balancing stocks and bonds. In 2026, Bank of America argues that both sides of that equation are exposed to the same systemic risks. Tangible assets like silver are no longer optional hedges, but core structural components required to stabilize portfolios against currency dilution. As high net worth investors begin to internalize this shift, the report warns of a bottleneck effect. Billions of dollars attempting to enter a market with limited physical supply create conditions where price becomes the only balancing mechanism. This is where gradual bull markets transition into vertical price events, driven not by speculation, but by forced repricing. The 0.5% ownership statistic stands out as perhaps the most bullish metric in the entire analysis. It quantifies apathy rather than enthusiasm. Many investors assume that silver reaching $78 implies that sophisticated capital is already fully positioned. Bank of America demonstrates the opposite. The rally to date has been driven largely by retail participation and early adopters, while institutional heavyweights remain mostly absent. Pension funds, sovereign wealth funds, and major endowments currently hold negligible exposure to silver's price action. When these entities act, they do not accumulate gradually. They secure vault capacity, negotiate long-term supply agreements, and acquire future production directly from miners. The scale of their participation overwhelms existing market structures. Bank of America highlights the mathematical impossibility of satisfying a universal 20% allocation at current prices. The total value of global silver inventories would need to expand dramatically to absorb that capital. This expansion can only occur through price appreciation. At higher prices, the same ounces represent more value, allowing capital inflows to be partially absorbed without exhausting supply entirely. The report implies that purchasing silver at $78 is a fleeting opportunity because the largest capital pools in the world have not yet entered. Waiting for pullbacks becomes increasingly risky as the liquidity gap narrows. Whitmer's warning is clear. The volume of currency seeking refuge in hard assets vastly exceeds available supply. Once institutional rotation begins in earnest, price acceleration becomes unavoidable. Bank of America concludes that the world is structurally underweight, the very asset class positioned for historic repricing. As this realization spreads, the 0.5% crowd will inevitably transform into the 20% crowd, and the market will be forced to adjust accordingly. The third and most decisive pillar of the narrative unfolding on January 6, 2026, rests not on charts or capital flows, but on the physical reality beneath the global economy. Bank of America emphasizes that the silver market has now entered its fifth consecutive year of a structural supply deficit, a condition that reflects deep systemic constraints rather than temporary disruptions. This deficit represents a fundamental imbalance between how much silver the world consumes and how much it can realistically produce. The report makes clear that this shortage is not the result of a single year of weak output, but the culmination of half a decade of mounting pressure. Global silver supply has failed to keep pace with demand since the early 2020s, and by 2026, the gap has become entrenched. This is not a supply chain issue that can be resolved through logistics or inventory management. It is geological, industrial, and economic in nature. Bank of America's analysis highlights a troubling trend within the mining sector itself. Production forecasts from 13 major North American gold and silver miners show an expected decline of approximately 2% in output for the current year. This decline comes despite historically elevated metal prices, contradicting the traditional assumption that higher prices naturally incentivize increased production. The reason for this contradiction lies in the rapidly rising costs of extraction, known within the industry as all-in sustaining costs. The report uses gold as a benchmark, noting that average all-in sustaining costs have climbed to roughly $1,600 per ounce. Silver miners face similar inflationary pressures across every input category, from diesel fuel and electricity to skilled labor and heavy machinery. As mines age, ore grades decline, forcing operators to process more material to extract the same amount of metal. At the same time, environmental regulations have become more stringent, permitting timelines longer and capital requirements steeper. These factors combine to create a ceiling on how much new supply can realistically be brought online, regardless of price incentives. Bank of America describes this moment as peak silver, a point where humanity is consuming more of the metal each year than it can extract from the earth. Existing mines are producing less, not more, while new discoveries are increasingly rare and expensive to develop. The easy silver has already been mined, refined, and absorbed into global infrastructure. This reality establishes a hard floor beneath the current $78 price level. Miners cannot profitably sell silver at significantly lower prices when production costs are approaching record highs. Unlike financial assets that can be issued or expanded, physical silver supply is constrained by physics, geology, and time. Compounding this supply pressure is a powerful and growing source of demand. Bank of America underscores the expanding industrial role of silver in 2026, driven primarily by the global energy transition. Silver is a critical component in solar panels, electric vehicles, power grids, and advanced electronics. These industries do not have substitutes available at scale. Industrial demand for silver is inelastic, meaning manufacturers must secure the metal regardless of price in order to maintain production. This creates a non-negotiable baseline level of consumption that persists even during periods of price volatility. When industrial demand is layered on top of investment demand, the deficit becomes unavoidable. The report notes that no major new silver mines are scheduled to come online in the near future. From initial discovery to commercial production, the timeline for developing a new mine ranges from 10 to 15 years. This means that even if prices were to surge immediately, additional supply would not materialize fast enough to alleviate shortages. As a result, existing above-ground inventories are steadily being drawn down. Vaults that once held strategic reserves are now supplying industrial users and investors alike. Futures contracts and paper instruments can facilitate price discovery, but they cannot create new physical ounces when inventories are depleted. Bank of America warns that the disconnect between paper pricing and physical scarcity is approaching a breaking point. In the fifth year of sustained deficit, confidence in paper claims becomes increasingly fragile. When holders of contracts demand delivery, the limits of the system are exposed. Michael Whitmer argues that supply constraints act as a multiplier on the demand pressures already building from institutional reallocation. When trillions of dollars seek exposure to an asset with declining production and finite availability, price becomes the only variable capable of restoring balance. Mining companies themselves are identified as strategic assets in this environment. They control the sole source of new silver entering the market. As production declines and development timelines extend, ownership of productive assets gains premium value. The report frames this not as a temporary cycle, but as a long-term structural shift. The ongoing decline in output serves as a warning that the global economy has consumed its most accessible silver resources. What remains underground is harder, deeper, and more capital-intensive to extract. This ensures that the deficit will persist, regardless of short-term price movements. From this perspective, the $339 target is not driven solely by ratios or institutional behavior. It is rooted in absolute scarcity. The $78 price is supported by the hard economics of mining and the relentless pull of industrial demand. As evening settles over New York on this Tuesday in January 2026, Bank of America's message crystallizes. The silver market sits at the intersection of ratio reversion, capital rotation, and physical depletion. Each force alone would support higher prices. Together, they form a self-reinforcing mechanism. The path forward is defined by mathematical certainty rather than speculation. Supply cannot expand, demand cannot contract, and capital cannot remain idle forever. The era of undervalued silver has ended, and what remains is a structural revaluation unfolding in real time, reshaping the future of money itself.